All right, so great segue on silver because, I've been talking to Peter for years now. I'm not sure, Peter, welcome back to Face, but he's been a long-term bull on precious metals. I remember silver was 13, 14 bucks, and he said, and then even after rally, he said it had a long runway. So, Peter, how are you? It's great to have you back and be
Morning.
able to catch up with you.
Morning. Same here. Thanks for
All
having me.
Okay, Peter. So I just want to start off with what I believe to be your most wonderful forecast you ever made since you and I have been talking. Do you know what it is?
Um, Inflation, maybe?
No, it was that before we really had the rollout, you were saying that the vaccine you were very hopeful about the vaccine and said
Okay.
that by this summer we'll be able to go hear some live music and go to a
Right.
concert. So, there's no one on the other side of that trade. That trade is good for everybody. And it looks like, your belief and your conviction that it could happen is manifesting, that we'll be able to go out and hear some music this summer.
I had no idea about the effectiveness of the vaccines, particularly, when Pfizer on November 9th said that theirs is more than 90% efficacious. I just felt that going into the last 2 months of last year, we were going to get results. And even if uh, the efficacy number was closer to 50%, which is pretty much what the flu shot was, I felt that
Right.
that was uh, a good sign that people were still going to get vaccinated. While certainly not the same level of protection, it was going to be enough to turn the corner. So when you looked at last year, September, October, where a lot of uh, the out of home stocks were trading, whether it's leisure and hospitality or cyclicals, a variety of other stocks that got hammered last year, there was from a risk reward standpoint going into there, I felt like an opportunity, and but certainly had no idea that the vaccines would be this effective.
Okay. Well, anyway, it was, maybe it was a hope, but, hope is the oxygen in our lives and the carbon monoxide in our trading. So, I want to talk to you about some of the things that have happened since you and I got back together. Of course, we passed the last rescue package of 3 trillion. What is your belief as far as the infrastructure bill that President Biden is proposing? Do you think that they're going to be able to get something done there?
They'll get something done, but I don't think it'll be certainly as large as they first threw out. I mean, I
Okay,
think that the revenue raisers that they've talked about,
right.
particularly on the capital gains side, is so extreme that you wonder if someone within the White House can call themselves an economist by even throwing out that number.
Yeah, like a
Uh,
trial balloon and the market see how the market would react to that and people
well,
would
it's hard
react.
to believe that even an economist would throw out that kind of trial balloon because there's no economic rationale for even something that is that high. Because once you get above a certain level of on the capital gains tax rate, you actually do damage because you never take in the revenue that you think, and you do you drag on the economy as well. So it's double negative, and I don't know uh, who would have thrown that out there and called themselves an economist at the same time.
Yeah, isn't it a bit contradictory to the rhetoric about, we need to give this economy as much help as possible, and then raising taxes could be, putting the brakes on anything that happens. I mean, raising taxes is not, bullish for economic activity, is it?
No, not at all.
Yeah,
But we know that policy is not necessarily being made on strictly uh, economic
economic. Yeah,
foundations.
yeah.
So, but you talk about infrastructure, and we talk about it in a very simplistic way. And for your listeners that have traveled overseas, you probably noticed that at least relative to many airports in the U.S., particularly those in the Northeast, airports outside the country are much nicer. And that is not because they spend more. That is because a lot of these airports overseas have been privatized, where you can actually buy stock in a lot of publicly traded airports outside of the U.S. You can buy stock in a lot of highways, toll roads outside of the U.S. Now, there's some in the U.S. that are privatized, but there's this belief that we don't spend enough, but there's also a belief that we spend plenty, it's just not being efficiently spent. I mean, everybody who goes over a bridge, at least that lives in the Northeast in New York, knows that New York City is taking in an enormous amount of money in tolls. And then you just have to ask, well, where's all that money going? So it's not like there's not a flow of money and ways of paying for these things.
It's government versus private ownership. That's the difference.
Yeah. Yes, for sure.
Okay.
Peter, good morning. Same thing happened to Greece. We have a lot of airports because we have a lot of islands. Many of them were at a tragic situation. I mean, public and all. We sold 30 of them to Fraport, which is like a German company. And guess what? They're now making money, and they've now become beautiful airports from like abandoned. I don't want to use bad words, but if I have to describe them, I will be forced to. If public spending actually created wealth, then all countries would be wealthy.
Right, and you give the good example of Fraport as an airport that you can buy. You can buy a piece of Heathrow. You can buy a piece of the Paris airport, Charles de Gaulle. You can buy even the Beijing and the Shanghai airports. So ironic that you can buy stock in a Chinese airport, but you can't buy stock in JFK Airport.
Well, great idea, but probably a very big long shot, considering we have a Democratic administration that believes government is, the solution to almost every problem. It'd be interesting and probably a great sign if Biden would break with that and do some private-public partnerships. We'll see. It's only been 100 days.
Yeah, well, another problem is actually finding. So let's just say you decide on a project. The amount of time that it takes to, first of all, decide on a project, design the project, get permitting for the project,
Years.
and then actually hire people to do the project. I mean, right now we have major supply side issues with labor. We have help wanted signs everywhere. We have almost 7.5 million job openings in the U.S., which is near record high, and you have employers that can't find employees. Now,
why is that people just do not? All the people that lost jobs, they probably don't have the skills for a lot of these jobs. But could it also be that once you put people on the dole, that they're not as motivated to go out and work for the same amount of money that they would make in the private sector until all these support programs are over?
That is definitely a major factor. If you think that based on regular state paid claims plus the added $300, in many places it's the equivalent on a 40-hour work week of $17 to $18 an hour.
Yeah.
So a lot of employers, particularly lower income employees like at restaurants and movie theaters or that rely more on tips, that is tough to compete against. Look at high school kids. How is someone going to hire a high school kid if they're competing against $18 an hour? Not that a high school kid is getting unemployment benefits, but could be for the summer. Could you get my point? So that is an issue. That this major disconnect between a high level of job openings relative to the large gap between the number of people that were hired in February of last year versus now. Plus, you make the good point about skills mismatch. Also, I'm sure that there are issues with schools and not being reopened. So that probably led to one of two parents being at home.
So could this also lead to higher wages competing, and wages could be part of the inflation mode that we're moving into, higher wages finally translating into a stronger consumer and more demand and higher prices?
I believe so. I think in the Fed Beige Book a few weeks ago, there were quotes from different companies that were forced to raise wages. Now, it's a good thing to have higher wages, that's for sure, but it's better to have higher wages based on higher productivity, rather than because you're competing against unemployment insurance, for example, or a skills mismatch. So there, I guess you can call it healthier ways of getting higher wages, because
Okay.
the higher wages through better productivity means that companies are able to absorb those higher wages and employees can make more money. If they're being forced to raise wages now just to get people um, off the sidelines, well, they're going to try to recoup that through higher prices to the consumer, with a more challenging opportunity to get that through productivity gains, which then gets into an inflationary situation that I believe that we are in the early stages of.
Okay, early stages of inflation. I wanted to ask you about, a lot of people drawing comparisons to what's happening in the market to the 2000 bubble. But the major difference, I'm wondering what you think about this, is that there isn't just a dot-com bubble going on here. You can't find an asset class that isn't some type of bubble. Real estate, equities, commodities, look at the grains, crypto. You have these NFTs that I'm not even sure what they are. And have you ever seen even some of the junk altcoins are going up 1,000%? Have you ever seen more rampant speculation across the board in so many different asset classes in your career?
Well, it's pretty rampant, as you say, but the ultimate bubble where all the assets you just named are a byproduct of that is in fixed income. It is in a world of negative and zero interest rates.
Okay.
And the European bond market is, to me, the biggest bubble in the history of all financial markets, obviously driven by ECB policy. So everything else that is priced off that low cost of money, therefore, as a byproduct, are bubbles too. But of course, bubbles can last. That's why this inflation discussion is so important, because if there is one thing that can alter and pop these bubbles, or it is if inflation digs in on a more than temporary basis, and that then filters into higher global interest rates. Not that central banks are going to be pushing rates higher anytime soon on their own, but market-driven interest rates have already had a move. And look at the U.S. 10-year. We've gone from 90 basis points to even today 158. We were almost as high as 180 not too long ago. The German 10-year is the least negative in about a year. It's still negative, of course, but it's at least the least negative. That there was such a move that the ECB came out and said we are going to front load our purchases because we don't like the rise in interest rates. So the bond market is beginning to sort of get a voice. They're having their own sets of opinion on the growth and inflation story that is different than where central banks want interest rates to go. And again, that's why this transitory or not transitory discussion on inflation is so crucial.
So this was the reemergence and the resurrection of the bond vigilantes right here, Peter. This move I'm showing from 0.5 to 180. They went away for quite a long time. You think they're back? And to me, it looks like maybe the 10-year might even be able to pull back to 1%. If we get a break in rates and the lows are in, could this next break in rates, instead of being constructive for the market, be caused by some type of correction in the market where we get some type of flight to quality in the bond market? Like here's TLT. It looks like it could
rally from here a bit, that it'll be, people might be rooting for lower rates, but, if we get lower rates and the market doesn't respond, that, people might be moving into bonds because of, valuation levels in the S&Ps as they approach 4,200.
I think the risk is ever higher rates. I don't.
Ever higher.
I think we're carving out on the 10-year range of 1.5 to 1.75 here. And
1.5. Okay.
yeah, and I think that once you get to sort of June, July, August, when there's no more transitory excuses on inflation, that if inflation remains sticky and moving still higher, I think that's when you get the leg in the 10-year up to 2% plus.
Yeah. Okay. Because this would measure if we had, developed some type of right shoulder here. I know, maybe, technical analysis is in your bag, but, a move from here, would take us well up above 2%. Like, what did you say, 2.5, Peter?
I think 2.5.
Okay, right here.
2.5 on an overshoot, but certainly 2.
Okay.
And again, that will be the case if inflation doesn't recede like the Fed so hopes that it will.
What are you expecting from them this week, Peter? On the presser, last month, he always, everyone's expecting the same song where, dovish, dovish, dovish. Could there be any hints about a taper? Canada was the first country to do it. Could Powell possibly hint about it? And like you say, they're S&P dependent, not data dependent, and they have a cushion with the market being up at 4,200 that, if we came off 5-10%, it wouldn't be the end of the world. It's not 2,500, it's 4,200.
So yes, Canada announced a taper, and they also announced that they expect that their inflation target will be met sooner than their previous estimate, which implies a rate hike sooner than what they thought at their January forecast. The Bank of Japan, about a month ago, announced that they were going to tolerate a wider band around their yield curve control. There was a Bloomberg story on Friday that discussions are heating up within the European Central Bank about tapering their emergency pandemic purchase program and not waiting till March 2022 when it expires. So the pressure on the Fed to at least begin a taper is intensifying. Not that QE out to 5 or 6 years is doing anything other than psychological. The pressure is growing. I mean, you just look at where commodity prices are. Tomorrow, we're going to print an almost 12% year-over-year increase in home prices. And the inflation pressures, at least on the good side right now, and spilling over into the services side, are just, as I said, intensifying for supply chain reasons, transportation cost reasons, potentially now higher wage cost reasons, commodity price reasons. I mean, copper today is printing a 10-year high. Corn is up sharply just over the past couple of weeks. Soybeans, wheat is now above $7 a bushel.
Look at that.
And now commodities are only a small, a portion of the inflation story, but you had United Microelectronics, a big semiconductor company in Taiwan, announcing last week, according to TSY10s, that they were raising prices by 40% in 2022. Wow. So for the Fed to just sit here and continue on with QE and with this backdrop is just totally reckless. And now I don't know if Powell is ready to be talking about this on Wednesday, or he'd rather wait for the following meeting to sort of get more evidence of where the economy and the inflation story is going as the weather warms up and more people go outside. But like I said, the pressure is only going to pick up for him, and I'm not sure how he dances around it because, like you said, and I've said, that they are so market sensitive. And I just want to emphasize that, this inflation discussion, and I'm not talking about high inflation, I'm talking about higher inflation. And the reason why that makes a difference is that if we didn't live in a world of negative interest rates or zero interest rates, and we had the Fed funds rate at 2-3%, and we had a 10-year north of 3%, those kind of interest rates can absorb a rise in inflation. a modest rise in inflation. It can absorb a 2-3% type inflation rate. But with yields where they are around the world, there's no shock absorber for a move higher in inflation. We're just not set up for it. Central bank policy is not prepared for it, even though central bankers want it. So that's the difference.
Financial markets aren't set up for it either, are they?
Correct.
Okay, so that could be something that could be a little deflationary if we had a pretty good break in the market. Don't you think it could take some of these asset prices that have just gone to the moon, correct with the market? They say you could own the best stock in a bad market and it doesn't matter. So if we get that type of correction, maybe that would be a little bit of a headwind for the economy if we had, so dare I say it, 30% sell-off in equities. Wouldn't that put a damper on inflation, or would they continue, continue to run in a liquidation move in the market?
Well, it would be. It's very circular here because it would be inflation or higher rates that would cause the pullback in the stock market.
Okay, so you don't think that happens until we start heading above 2% or so, and the valuation models change?
Well, we've already seen, a massive rolling rotation this year. We've seen air come out of even Bitcoin over the past week. We've seen air come out of the SPACs, air come out of a lot of the very overvalued work from home stocks of last year, like Zoom, for example, or Teladoc. So we have seen a rotation. We have seen some air coming out of these high-flying stocks. And you can say, well, some of it is because we're reopening and people are rotating, but you see a pretty sharp rise in rates in the long end. I mean, you have to understand that, we're so afraid of the Fed to raise rates, but the 10-year has essentially raised rates 3 times this year.
Right.
Somehow that's good in the eyes of the stock market, but God forbid the Fed raised rates 3 times, then it would freak out. But either way, cost of money, 10 years plus, has gone up sharply this year. And even the 5-year was about 35 basis points at the end of last year. And now we sit at 82.5 basis points. That is essentially, those are rate hikes.
Okay. In this environment, Peter, what are you advising people to do in this environment? You're still finding value in emerging markets have been under some pressure. What direction should we be considering? Looking overseas away from the U.S. because the dollar weakness?
I am still positive on emerging Asia.
Okay.
To narrow that down. And because emerging markets obviously includes everything from Asia to Brazil to South Africa to Mexico. I like emerging Asia. I think the Asian growth story over the next 10 years is hugely compelling, and those markets will well outperform U.S. markets over this time frame. I'm still bullish.
What countries? Vietnam?
Vietnam, South Korea and Singapore, not really emerging markets. They're fully developed. But very bullish on them. Taiwan,
Indonesia.
China, India, Indonesia, Thailand. That's just the whole reason. They're very compelling growth stories. And I even like Japanese stocks. Obviously, it's not an emerging market, but I think Japanese stocks are going to be a key beneficiary of that Asian growth. I think commodity stocks are still attractive, energy stocks, fertilizer stocks, precious metal stocks. And there's still value stocks out there that I find attractive. I'm just gun shy on the overvalued parts of the tech market where you have these amazing companies, but valuations that go along with it.
Do you think that it's possible, Peter, that we're declaring victory against COVID, kind of like when President Bush landed on the aircraft carrier? And it was not the end, it was the beginning of the end, not victory.
No.
With all the variants out there, do you think that there's a possibility that some of that people that are fully vaccinated could start to contract it? That would unwind the whole reopening story if something like that happened in the fall.
It could, but I'm confident in the efficacy of these vaccines, and I think whether people are going to need a booster in the fall going into the winter or not, I think the COVID numbers are going to collapse around the world over the next month, and it's going to become something that we'll have to live with, but something that we'll be able to manage well. So the medical world, I believe, will conquer COVID, and I think we're clearly seeing the signs. I mean, in the U.S., there's still 3 million people a day are getting shots.
Yeah.
So if you look at the experience of Israel, we are basically where Israel was back in February, and their numbers started to collapse soon after. And you're going to see the same here. Europe is even getting better in rolling out the vaccine. Obviously, you have issues like with India. That's been terrible with the big flare-up. But I think they will get back in control of it, and they will ramp up the vaccine rollout. And plus the summer and people being more outside, that I think that we have now control of COVID rather than the other way around.
Okay, well, that's great news, and I'm certainly, tired of being cooped up and starting to get out there a little bit. Peter, I've talked to a lot of people, and you brought up Europe, and a lot of the bears are very concerned about banking crisis. The Italian banks are basically broke, and there's some votes coming up in Europe. There's also the Scottish referendum. And why do you think Draghi is playing, after being, the head of the ECB, playing such a big role in what's happening in Italy right now?
Well, people perceive Draghi as this statesman that has sort of the moral authority of his people.
I'll do anything it takes.
Right, even though he was the most dangerous central banker ever to walk this earth and has just destroyed the region's bond markets, and God forbid they ever have to get out of zero interest rates. But it's just perception. And I don't think Draghi will have a political history any different than what we've seen from Italy since World War II, where we've had probably 60 to 65 different governments since then. And now, obviously, the big test is how these countries are going to spend the 750 billion euros that are going to be sent to them via grants and loans. And obviously, each country is coming up with their own plan to how to allocate capital. But it's all central planning that is going to be allocating this capital, and that will all end in the same way. And that will be Draghi's
swan
song, but not in a good way.
Yeah, he should have done what John Elway did: step away after you win the Super Bowl. So, so Peter, it's great talking to you. I want to just show everyone your website and how they could follow you. You can go, Peter, if you want to follow him on Twitter, it's at Boockvar. And here's your website. And ahead of the, he's prepping his people for the FOMC meeting, and there's some great content on here. And do you think we'll ever, middle-class people will ever be able to buy a home again in America?
Well, it's another unfortunate thing that the Fed has done is again, like we haven't seen this before, goosing home prices to such an extraordinary extent. And not only that, making it even more difficult for the first-time buyer to compete against all cash buyers, pension funds, private equity, foreign investors that are now buying homes so they can rent out in their yield grab.
Right.
So it's really a shame. And so I root for a slower pace of home price gains because we need that first-time home buyer, and we lose them with these kind of aggressive home price increases.
All right. Well, Inflation Bull, Peter Boockvar. Thank you very much. It was great talking to you again, Peter.
I appreciate having me on.
Yeah, I hope you have a great summer, and
thank you. You too.
We'll talk to you, in a few months. We'll get back together and see what's happening. Peter Boockvar, everybody.
Thanks so much.
That's going to be a wrap. Remember, don't just count your inflation hedges, count your blessings. Could join the team in 14 minutes for the Morning Edge, and we'll see everyone for Turnaround Tuesday. It's going to be a exciting week with the Fed, so keep some powder dry. And that's going to be a wrap. Thank you, everyone. See you tomorrow.